Hi, well, this is a short screencast covering question 48, John, in the BPP Practice and Revision Kit for F6 Taxation IRE. Okay, so this question covers capital gains tax. And if we look at the requirements first, in fact, we should always look at our requirements first so we can figure out when we're reading the scenario really what we're looking for. Okay, so it's in two parts. The first part, typical sort of F6 type question, simply asking us for a capital gains tax liability for an individual. Also asking us to explain whether or not any particular transactions above are exempt for capital gains tax purposes. And invariably when you look at these types of questions, there's always going to be one, possibly even more than one that's exempt. So in your studies, do look out for assets that are exempt for CGT purposes because you're bound to come across them. Okay. Part two is just really a little bit of admin about withholding tax. So we've got to figure out what is that. A little bit unusual because it relates to withholding of proceeds. Now, in terms of an approach to this question, as I've mentioned up here, really two parts. First part is computational, second part is simply written. You've got to be thinking, particularly in the computational parts, of exactly how you're going to lay out your answer. And one of the things that we've talked about in class is really this idea that we sort of have a couple of pages, really, broadly speaking, or perhaps a couple of different areas of the answer. That our second page is really our gains and losses. So our three-liners, proceeds less cost equals gains. And we're aiming for some sort of net gain figure across really 5 assets above. Our page one, or let's say our second area of this CGT question, is going to be, how do we calculate the tax? So it's got to be some sort of net gain. We're going to use AE, possibly losses brought forward if they're relevant, and then apply the 33% rate. So, before you put pen to paper, have an idea of how you're going to lay your answer out. That's going to give you a little bit of confidence, and so it's going to help you score marks. Okay. Second part, as I've said, this admin area, withholding tax, obviously a written question. There's a question of rote learning this information. Okay. So let's have a look at the body of the question. If we look above, again, standard format really for F6, they'll even sort of number the assets. Okay, so asset number one here, first thing that we see is that it's a principal private residence. And once we see that, we've got to be thinking again of format. There are a number of easy marks to be gained here, and certainly there are a number of perhaps more difficult marks, tricky little marks, because we're going to be given details on a variety of different periods, and we've really got to slot them into either exempt or indeed chargeable. Okay, so if we look at this question, we see that we're told about proceeds here. We're also told a little bit about costs in this area. And remember that we're going to score marks in our answer simply for laying out proceeds less cost equals gain. And that's before we get to any of the tricky bits in relation to the fraction or exempt periods or chargeable periods, etc. Okay, so what they do is they give you an inheritance. They also give you a market value of 6th of April 74. Really what you've got to do is to figure out what's the cost to be included. So more of that later. In terms of the periods concerned, I've got a lot of information here, and this is the type of or the method in which the examiner will use to sort of confuse you. And I think overall what you've got to be thinking of is, what are the periods that are going to be either normal occupation or deemed occupation, and what are the periods that are going to be really chargeable. Okay, so you remember from our your studies and our studies in class so far is that really we're looking at a set of columns, and those columns have really got to enable us in some way to identify these actual occupation periods and indeed the deemed periods. And you will remember hopefully from your studies that there are 3 main deemed periods, and more of those later. Okay. In terms of the detail of the answer flowing down from here, again, as I mentioned above, a number of different periods, and we've really just got to split them up. They do give us some information here about an extension to the house, and again, that's just a cost. In other words, that's just a cost that we're going to include in our 3-liner. Okay. Um, if we move down, we'll see the standard stuff in this asset number one. In other words, a reference to the individual moving away from home for work purposes, either in Ireland or perhaps in this second paragraph here, it looks as if they're moving abroad. So, those deemed rules, as I said above, those three deemed rules about the length of the period that is going to be exempt, assuming that the property is preceded and followed by a period of actual occupation, we must rote learn those rules because you've got to be able to spot them. Okay, so I'll go through the detail of the answer in a moment, but essentially that's the setup. We've got some sort of three-liner. We've got a split between actual and deemed occupation versus really chargeable. And we've got to figure out what's in and what's out. Okay. Asset number two here, again, out of six, I would be expecting these, what we call chattels, wasting assets, and indeed non-wasting assets. Number two, we see some furniture and fittings, and we've just really got to really have a list of these types of assets and be able to slot them under either, the wasting asset banner or the non-wasting asset. In this particular case, we're saying that furniture and fittings is a wasting asset. In other words, its life is less than 50 years. Okay. Now, in terms of the information that they give us, they do give us some proceeds here. We also see that we have a cost of 40,000. So it looks to me as if they're setting this up as a question where costs are more than proceeds, and indeed it's a wasting asset. So what is the trick associated with that? They even very kindly throw in some auctioneer's cost. And I think we'll find when we look at the answer that in fact where we have a loss on this type of asset, i.e. a wasting asset, there's a particular treatment that may revolve around us not doing any work at all. Okay, more of that in a moment. Asset number three, we have an antique table. Now, if you think about it, it is some sort of wasting asset. Is it wasting or is it non-wasting? We've got to think about, again, putting that under each of those headings and saying, okay, well, if it's a non-wasting asset, then what is the treatment based on the numbers? And we see that the numbers here, we have proceeds, again, of 2,000, and we have a cost of 4,000. So again, it looks as if we have a non-wasting asset, or sometimes referred to as a durable asset, and we have a loss. So again, what is the treatment for that type of asset? More of that in a moment. This next area here, again, a very, very popular area for F6 CGT questions. It's our old classic part disposal. We have 1 acre being sold out of a batch of 5. Okay, so we should remember our formula, our A over A plus B. We're really just looking to extract out of the original cost the element relating to that 1 acre. They very kindly give us the proceeds here. We also see that we have the original cost and also the value of the remainder. So we've got to be able to slot those figures into our formula and come up with some sort of gain or loss and then go from there. Okay. The next thing we have, again, another non-wasting asset, a durable asset, in effect, a necklace. Now they do mess around with the costs here. They give us a market value on inheritance. They also give us an original cost in 6th of April 74. So they're trying to confuse us. In other words, they're trying to perhaps make us dilly-dally and think about, well, which cost should we include? So again, more of that later. You've got to be able to pick up the correct costs easily. Okay, they give us information about a valuation. We don't actually have a proceeds. Bear in mind that this is a gift of a necklace. Yeah, so that means that it wasn't a sale. There was no proceeds as such, but they do give us a valuation at 12,000. So in effect, there's our proceeds. Okay. Also, obviously, it's some form of connected party situation. Okay. I've just mentioned here about durable chattels and an MOR calculation, more of that later. Just got to watch out for the various tricks in this area of durable versus wasting assets. There's quite a few of them and they're very, very popular. Okay, so that's the setup of the question itself. Let's have a look at the answer here. You'll see that they refer in the first instance to PPR and the various rules of periods of occupation, deemed occupation, etc. And I mentioned that above. So really, in terms of the setup, if I just scan down the question, you'll see that sort of, I guess that they put their sort of page 2 first, as it were. We just have a series of assets. We have some workings. They just go 1, 2, 3, 4, and with each of them, they calculate some sort of gain or loss, so they say that the asset is exempt. Yeah, we get to number 5, and then they have, in effect, their page 1 after their page 2, which is just really a summary of the gains or losses, obviously the AE being deducted, and indeed a calculation based on the 33% rate. Okay, so that's a quick scan. Let's go through the detail now. What we'll see again, they just lay them out one by one. And that's the way that you should do it. You're trying in your answers to obviously replicate exactly what they've got within reason. Okay, so asset number 1 clearly laid out. This is the principal private residence. First thing that they do is lay out the basic information in relation to the 3-liner. Now, the key point here is obviously this area here of the PPR relief. Yeah, but let's just leave that for a moment. If you look above, look really sort of down to here. Yeah, this is just a simple subtraction. Yeah, in other words, it's proceeds less cost equals gain, and you're going to be scoring marks, half a mark to a mark for each of these items. Okay, so even if you had difficulties with this area, you didn't get the right number, there's some very, very easy marks to be had here. So don't forget about that in these types of questions, and indeed across your F6 studies. It's important that you score the easy marks. That's just taken from the question, as is the market value on 6th of April 74, and indeed the extension. So there's just a couple of costs there. Obviously, we're just indexing up based on the factors in the table. Okay, so the 3-liner sets itself out in a fairly normal fashion. We get to this figure here of 386,292, and then what they say is exempt gain, and they have a note down below. So in terms of principal private residence relief, just bear in mind that all that we're trying to do is calculate the gain as normal and then extract out of it any element that we're saying is exempt under the PPR relief rules, okay, to get to a taxable gain. So how do we get to this figure here of 338,305? Well, you'll see, as I mentioned above, it looks as if we have to use some form of table. Yeah, and what does that table hold? Well, really, in the first instance, we have relevant periods. Yeah, then we have some sort of time duration, and then they have a little note as to whether or not it's occupied or not occupied. Now, there's a number of different ways that you could come at this table. You don't have to do it exactly like them. What you could do very simply is to have a table that just simply lists the actual or the deemed occupied periods. You don't necessarily have to deal with the not occupied periods. Okay, so just find the way that you want to do it and indeed stick to that. Okay, what they do is they really go from the start, and the first key point here, yeah, is just this period prior to the 6th of April 74. Just make sure that you ignore that period completely. Ignore it. So really we're going from 6th of April 74 onwards. Anything prior to that is completely ignored. Now, in terms of the body of the answer here, you'll see that they've gone the whole hog and really listed every single period, every single date from and to. And I'm just going to pick out a few here, which are the sort of standard tricks for us to be familiar with. I mean, I guess the first one is that it's pretty easy for us to populate a table like this with the actual periods of occupation. In other words, the periods where this individual was living in the property. Yeah, so you could actually do that first if you leave plenty of space. Yeah, I mean a line or two, and you'll see that this period here he was actually in the property. That's got to be okay because it was his home at that time. Therefore, any gain associated with that period is exempt. Same with this one, and indeed the last one. So those periods are fairly straightforward. The more questions you do, the quicker that you'll get at being able to spot those periods, and you can just slot them in your table. The little tricks really relate, in this question at least, to employment elsewhere. And I picked out these two, this period of 1st of July 95 to 1st of July 99, and also this one down below, 1st Jan 2002, 1st of January 2007. Now, in this first period here, we're given in the question information that basically says that he was employed in Ireland in that period. Now, we should remember from our studies that employment elsewhere is perfectly okay and is deemed occupation up to 4 years. Okay, so that's why we can deem that as occupied, as long as there is a period both before and after that is actual occupation. And you'll see that for this one, obviously previously we had actual occupation because he bought the house, moved in. In fact, we have another period here. We do have actual occupation afterwards for sure, because you remember I said, well, let's populate this table with actual periods as much as possible before we do anything. Let's get the easy bits in first. So that period is definitely okay because it's preceded and followed by a period of actual occupation. But bear in mind, it's limited to 4 years, okay? And that's employment elsewhere in Ireland. Bear in mind, not self-employment, employment, okay? So that's the first sort of tricky one. The second tricky one is really this employment abroad, okay? So he's on an assignment outside the state, and do remember there that the period is completely unlimited, absolutely unlimited, okay? So it doesn't matter what the time period is, and there could be multiple periods as well, it doesn't have to be one, okay? And again, we see that it's preceded and followed by. And it doesn't need to be immediately preceded or immediately followed by, as long as it is preceded and followed by. Okay, so that period there is okay. So you can see that we're sort of just making up our table, trying to get the number of months under each banner, as it were. Now, this last period here, he moved back into the property 1st of January 2008, and then he sold on that date. So really, all of that period was okay. We didn't really need the 12 months. We could have put them in, but we didn't need them. We didn't need the deemed 12 months rule, i.e. the last 12 months. We can see that clearly he is in occupation. So what do we get from this? Well, basically, what we see is when we scan down the table, we're looking to pick out these occupied or deemed occupied periods and really compare them to the total period of ownership. Yeah, and this total period of ownership should be fairly easy to calculate. It's just really from point A at inheritance or occupation. Remember that's post 6474. That gives us 483 months. In terms of these occupied or deemed occupied periods, we've got 423 months. So what are we doing then? Well, we're basically saying that the gain that was calculated above, remember, as per normal, proceeds less cost equals gain. Let's take out of it this exempt element, and it must be 423 divided by 483, and that gives us 338305. So if we look to the comp above, I'll just go up above again, just to remind you what we were doing there. We did the comp as normal. We got down to an overall gain, and then we extracted out of it an exempt amount, 338305, and that's the figure below. Okay. Now, one of the points that I've made in class, which I think is important, is just this idea that there's a fair amount of work to do here, but the bottom line is that everything focuses around that number. If you do not have that number, you do not have it quickly, getting these types of questions done as quick as you can, it's just not going to happen. So this is the focus, and at the end of the day, your marker, when they look at your answer, is going to be looking for method. They're not necessarily going to be overly concerned if perhaps you've missed one period. Yeah, you'll lose some marks, but you're not going to fail the question. So, the essence of these questions is getting the numbers out quickly. This 483 should be quick. It should be easy to do. You might miss a month or two or a year, it doesn't matter. Okay. This 423 is going to take a little bit of time. So be conscious of the fact that you're aiming for that top part of the fraction and you're aiming for it PDQ. Okay. So there's the first asset there. That's done. Now this second one was a curveball. It's basically furniture and fittings. It's a wasting asset, and basically where it's a wasting asset and it's used for non-business purposes, it is exempt. So we've got to make a note that there's no calculation required at all. They did try to dress it up, I see in the answer, sorry, in the question. They gave us some details about it in effect being a loss, sort of auctioneer's fees, etc. They're trying to pull you into doing a three-liner, but we just need to know it's a wasting asset, therefore it must be exempt, assuming that it's used for non-business use. Okay. Now this next one, this antique, again, it's one of these either wasting or non-wasting assets. If you think about an antique, does it have a life of less than 50 years? Probably unlikely. I would say that an antique is going to have a life of many, many years. Therefore, it is a non-wasting asset. Now, in this particular case, as given in the question, we had some figures that show that obviously it's a non-wasting asset, but there's a loss. The figures in the question were proceeds of 2,000 and indeed a cost of 4. So we can see by looking at the question that there is a loss. So a non-wasting asset, non-wasting chattel, a loss is being calculated. What do we need to do? Well, we have to deem the sales proceeds to be 2,540. Okay, we have to deem. In effect, what we're saying is we're sort of restricting the loss. We're restricting the loss. So again, it may well be that you have to rote learn these little rules of wasting assets versus non-wasting assets. It's the only way. Couple that with doing as many questions as you can. So in this particular case, we're saying non-wasting chattel, a loss has been made. We have to restrict the loss in effect. So we're putting in a value for deemed sale proceeds that really make the loss 1,460. It would have been more than that if we'd stuck with the normal proceeds of 2. Okay, so that's asset number 3. Next one here, I'll just move down to this bit here because it's easier. We've got a double count there. We've got our old favorite part disposals. And again, easy marks to be had here. All that we're looking to do is extract out of the cost the value associated with the 1 acre. And that's A over A plus B, where A is the proceeds and B is the value of the remainder. Again, simple three-liner here. Yeah, just proceeds less cost equals loss. Yeah. Now, bear in mind that our indexation relief rules really require us to consider a situation where we're either creating or augmenting a loss. Okay. So in this particular case, it looks as if on a monetary basis, we have a gain. But on an index basis, i.e. after allowing for indexation relief, we have a loss. Okay, so in this particular case, what they're saying is we have to change this in effect to a no gain, no loss situation. In other words, where you have a monetary gain, you cannot use indexation relief to create a loss. So what happens? Well, you simply have to bring the costs to zero, bring the gain or loss to zero. And this is what they do. They basically say we have to restrict the loss. In other words, get rid of the 963 and take the loss as nothing or nil. Okay, so again, a little bit tricky in terms of concept, but again, question practice is key. We cannot create or augment a loss, and here what we're doing is we are creating one, okay, by using indexation relief, and we're not allowed to do that. Okay, so the value to be included in the summary is going to be nil. This next one here, this necklace, again, it's really a non-wasting chattel or a durable chattel. We just need to know the rules, okay? And in this particular case, it wasn't overly complex because we were given a market value. Bear in mind, it was a gift, so we have to slot in market value. We're also given a cost. We simply take one from t'other and get a capital gain. Now, what I've said here is that there's no need for the MR calculation. You remember that the MR calculation is based on that difference between, or the maximum CGT is really just 50% of the proceeds in excess of 2,540. Okay, so if you do that calculation here, you'll see that that calculation would give you a much, much higher CGT figure. In other words, higher than if you calculated here. I think it's about 4,300 or thereabouts. So in other words, we have a non-wasting chattel or a durable chattel. We have a gain, and in that case, what they should have done here really is do a calculation based on that the maximum CGT was 50% of the difference between the proceeds and 2540. Yeah, and it would have worked out at a high figure, 4,300 or whatever. And you can see that that would be higher than if we include this down below in our summary. Okay, so have a look at your text on that and just get a fix on how that works. I'm basically saying no need to do it. Maybe they should have done it just for your purposes. Okay, so here we have our summary then. Yeah, we have our a variety of assets, 1 to 5. We're just summarizing them, yeah, to get to our net gains figure. This would be the figure perhaps on my page 2. I'd be bringing up to my page 1, and then I'd be applying the AE and obviously the rates. So what we have is AE being applied 1270. You know, don't forget that. You know, there's a mark just for doing that. And the exam, very easy to forget these little things. So, you know, do try to make a note when you get your gains or your net gains. Make sure you take off your AE. Okay, we get net gains here after the AE, and we're simply just applying our 33% figure. Now, in the question, they asked us to identify the amount of tax due, if any, for the initial and final periods. Okay, now what they mean by that is that in terms of payment of CGT, our initial period runs from 1st of January to 30th of November. So in other words, any assets disposed of in that period are subject to CGT, obviously, but that's payable on the 15th day of December in that year. Where assets are disposed of in December, i.e. between 1st of December, 31st of December, the liability crystallizes on the 31st of January following. So the initial period is in effect Jan to November inclusive. Yeah. Now you'll see from the question that all of the assets were disposed of in that Jan to November period. So therefore, this CGT bill of 16,516 is all in effect relevant to the initial period. None are relevant to the second period or the final period. Okay, so that's a basic summary there, albeit a fairly quick one, of question 48, John, on page 65 of your practice and revision kit, and hopefully that's helpful. Just take you briefly through section B. As I've said when we went through the question, you know, there's some rote learning to do here. You know, what does this mean, this withholding tax? So just remind you of the question. It basically says, you know, state the circumstances in which withholding tax will be withheld from consideration arising on the disposal of an asset. So in other words, you know, when will there be a requirement to withhold 15% note of the proceeds? Okay, so these are the situations where we have an individual who's disposing of what we would refer to as a specified asset, and that is basically land and buildings or unquoted shares where the greater part of value, i.e. more than 50% of the assets, relates to land and buildings in the state. This one here, a little bit obscure. Certainly, land and buildings in the state would be the most common one in practice. So this type of asset, yeah, it's certainly going to refer to the sales proceeds need to exceed 500k, and in addition to that, the vendor doesn't have any tax clearance certificate. So what does that mean, a tax clearance certificate? Well, basically, we've got someone selling an asset. We're really saying that, you know, you can get out of this withholding tax requirement, you know, i.e. the vendor can, if they're resident in Ireland and therefore paying tax on Ireland, if no CGT is payable for some reason, or indeed if the CGT has already been paid. Yeah. So really what we're saying here is that we have, let's say, a purchaser and a vendor. We're really, or the government, the Irish tax authorities, are requiring the purchaser to withhold part of the proceeds. In other words, 15% of the proceeds. And the reason that the Irish tax authorities are requiring people to do that is that they want to make sure that they get their tax paid. Okay, the get-outs are here. In other words, if the vendor is resident, if there's no CGT payable, or if CGT has been paid, in effect, these are guarding the asset, guarding the revenue, in effect, against an individual who perhaps may be non-resident, who's disposing of these assets and may well not, or decide not to pay the tax, or can't be bothered to pay the tax. So that's all that CGT withholding tax does. It protects the revenue and requires the purchaser to withhold 15% of the proceeds, just in case there's any issue with the individual concerned not paying the tax due on the disposal. Okay, that's about it. Hopefully that's been helpful. Do look at this answer carefully. It's a very representative of a CTT F6 question, so it's a good one to look at. Watch out for the tricks. They'll be repeated again and again, and good luck with your studies. Many